In this lesson, you're going to learn how we can finish linking together our more advanced LBO model by making some key modifications to our balance sheet. Now, previously we saw how we can make pro forma adjustments to our balance sheet by taking into account debits and credits as a result of the transaction and some of the new items created in the course of this transaction. And actually, for the first year here, for the pro forma 2009 number, we don't have any problems because our balance sheet already balances properly. The problems start occurring after that, where the balance sheet goes horribly out of balance. Clearly, we are not taking into account items here, and something is wrong. So we have to go through and start modifying this and making sure that everything is linking incorrectly. So to do this, I'm just going to go line by line and start with cash at the top and go all the way down to shareholders' equity and show you what you have to do to modify this to get it to work properly and to make sure that the balance sheet balances in all 5 years here. So for cash and cash equivalents, this is already being pulled in from the bottom of the cash flow statement. This is always what we do in any type of three-statement model, whether it's an LBO model or just an operating model or even a merger model. We're always pulling it in from the bottom of the cash flow statement, so we don't have to do anything here. Short-term securities, we're assuming stays the same all the way across, so that's fine. Accounts receivable and inventory, these are both changing as a percent of revenue and cost of goods sold respectively. So there's nothing we have to do here. These are already both reflected on the cash flow statement as well. Deferred tax assets stay the same, going all the way across here is what we're assuming. And then other current assets, these are also staying the same. So there's not too much to be done on the current assets portion of the balance sheet. Now under long-term assets, so we have long-term securities first. This one, again, we're assuming stays constant, so we don't have to do anything there. For plants, property, and equipment, so for this one, let's look at the formula. We're taking the old balance, and then we're subtracting D&A, and then we're subtracting, really adding CapEx. This is almost right, but we need to do one other thing here, which is we need to also subtract the depreciation of the PP&E write-up. The reason is because the PP&E write-up also counts as plants, property, and equipment, just like our existing balance, and so we need to be depreciating that over these 5 years as well. So I'll link that in and copy this formula across. Now goodwill, the standard treatment here is to assume it's constant unless there's an impairment. We have a constant number here, constant formula, so I'm not going to change this. Other intangible assets, so we are taking the existing balance and then subtracting amortization of intangibles. What we need to do here is also subtract our new intangibles amortization. So we need to subtract the fact that we've written up this intangibles number, we've created a whole lot of new intangible assets, and we need to be properly amortizing them and reflecting that amortization on the balance sheet. So what I'm going to do here is go down to the new intangible amortization number. And now we're subtracting both that and then the amortization of the existing intangibles. I'll copy this across. For the capitalized financing fees, this one looks like it's constant in this formula, so we're just going to change that by going down to our cash flow statement and subtracting amortization of financing fees each year. So now this is being properly reflected on our balance sheet. Other long-term assets we're assuming stays the same going all the way across here. Now on the liabilities and shareholders' equity side, we see that our balance sheet is actually even more out of balance right now, but that's okay. We're going to be fixing this, and we're actually moving closer toward the solution here. So on the liability side in the balance sheet, for the revolver, we're assuming it's constant all the way across. What we should actually be doing, though, is going down to our cash flow statement where we're tracking the changes in debt, and we're going to add this number in. The reason we're adding it is because, remember, in this formula, we're saying that if we have to borrow more on the revolver, then we add it. If we're paying off the revolver, then we subtract it. And so on the balance sheet, if we're adding more, we want our revolver balance to go up. If we're subtracting something from the revolver, we want our revolver balance to go down. Take this and copy it across. Accounts payable, accrued expenses, and deferred revenue, these are all being projected as a percent of expenses or COGS or revenue, so we do not really have to change anything on these. The same goes for long-term deferred revenue. Existing long-term debt is just held constant all the way across, so we don't have to do anything there. But for these debt items, we now have to go in and make sure that these are all being pulled in from the changes on the cash flow statement. So for term loan A, let's start there and go down to the cash flow statement. So we'll pull in this negative 9.8 billion number. We can actually copy this formula down for the other ones. Just check to make sure that we're pulling in from the right one in each case. The only addition we have to make here is that for the paid-in-kind loan, we have to go down to the cash flow statement and actually add in the accrual of the paid-in-kind note. Because remember that with paid-in-kind loans, the interest is not a cash expense. Instead, it just accrues to the principal of the debt. So in this case, we have to go in and add this accrual of the paid-in-kind note. So we have these in place, and now I'm going to copy these formulas across. So we see now that our debt is being paid down over the years. So term loan A goes down and becomes 0 in year 3. Term loan B becomes 0 in year 4. And then the high yield debt, the two tranches of high yield debt, stay the same all the way across here. PIK loan is actually going up. Subordinated note is the one that stays the same. The PIK loan is actually going up because the interest expense each year keeps getting added to the balance here. Now the deferred tax liability and other long-term liabilities, these are both going to be constant all the way across. If we want to be more precise for the deferred tax liability, we could create a separate schedule for this and calculate book taxes versus cash taxes. And we actually do that in the Yahoo LBO model, which is the most advanced LBO model in this training program. So if you want more on that, you can check that out. But for our purposes and for the purposes of PE interviews and what you use 90% of the time on the job, no one cares that much about the deferred tax liability changing. Most of the time, it makes a marginal impact at most on the model. So in this case, we're just going to assume it stays constant. Again, if we want to be more precise, we could make a separate schedule for this. We could make a separate schedule for many of these items. And we do that in the more advanced LBO model. But for our purposes, since we're focused on what you need for interviews and building models to impress PE firms, and also for what you use most of the time on the job, we're not going to be concerned with that kind of complexity here. So both these are constant. Now let's just double check our shareholders' equity area. Common stock is held constant all the way across. APIC, this is just pulling the existing balance plus stock-based comp. Treasury stock, it's constant because in this case we do not have the option to repurchase any stock, so this one is fine. Sponsor common equity, it's constant, nothing is going to affect this. Retained earnings, we are simply taking the old balance and adding in net income. We don't have any dividends here being issued, so it's fine to do this. We've simplified the cash flow statement and we no longer have that. Accumulated other comprehensive income, so we've eliminated the items that would have changed this on the cash flow statement, so it's fine to assume this one is constant all the way across as well. And so with all those in place, we now see at the bottom here that with our balance check, everything now comes out to 0. Which indicates that our model now correctly balances and that we're at the end of our more advanced LBO model. So we have finished projecting all three statements. We have finished creating our more advanced debt schedule, our purchase price allocation, adjusting the balance sheet and projecting it all the way across. And we're really done with this model now. The only remaining tasks are at the bottom. We still have to go in and calculate our return to the investors, in this case, the PE firm buying Apple. And then we're going to make some sensitivity tables similar to what we did in the basic LBO model, the merger model, and the DCF analysis. So that's what's coming up next, but we are basically done with this model, and you should now have a much better understanding of how you create an LBO model that has multiple tranches of debt, something that's more complex, something that is going to be more useful when this question comes up in PE interviews or when you have a modeling test for a private equity firm or even at an investment bank. This type of model is sufficient for what you'd have to be able to prove in such a testing environment. So coming up next, we're going to be calculating the returns and then looking at some sensitivities around all these numbers. And then after that, we're going to be getting into some possible interview questions that you may get on the topic of this model and more advanced LBO models, different types of debt, and related topics.